All right, welcome to another episode of StableSchool podcast. I'm here with Sam from the protocol called Spark. Sam, please take it away, introduce yourself, and please introduce Spark.
Yeah, thanks for having me. So I'm Sam McPherson, co-founder, CEO of Phoenix Labs. And so we are a contractor to Spark. Now, because Spark is a DAO, there's nobody that works directly for the DAO. The DAO just has a bunch of service providers connected. So this is why there's a difference in the names. So there's also a risk team, Block Analytica, that is involved. And so collectively, we all work to support Spark.
And so for the listeners, what is Spark, and how is Spark different?
Yeah. Okay. So let me run through the history with Maker a bit. So maybe some people are familiar with MakerDAO. It's like a OG crypto stablecoin protocol formed way back in the day. It actually formed before Ethereum was even in production. So 2014 is when they were first.
I didn't know that.
Yeah, it's from a long time ago. But the most recent, the DAI stablecoin that launched, that was launched in 2019, at the end of 2019. So that quickly grew in popularity. This was right around the birth of DeFi as we know it today. I think it was Uniswap was around at that time. Compound had just launched. It was pretty early days. So this, MakerDAO has been around for a while. It's the largest on-chain stablecoin, even to date. And so Maker has gone through a rebrand to Sky. And so as part of the learning experience, so there's an interesting history. So there's the product, which is the stablecoin, which is DAI. And then there's governance, which is attached to it. So there's kind of these two things that have been innovations. And so the DAO portion, through trial and error, we've kind of the original naive DAO structure, we've realized it doesn't really work. It doesn't scale. Unfortunately, this structure of having a flat token-weighted voter structure just ends up people fighting in politics and this kind of stuff. So it's not an optimal structure. So as part of the redesign of governance, there is a better structure that was arrived at where Maker would no longer be all the decisions for growth and stuff like that would no longer be done within MakerDAO. Instead, there would be redundant SubDAOs, and of which Spark is one of these. So Maker converts from being a decision-making apparatus to more of a rules setting. Here's the rules of the road. You can lend against these types of collaterals, this kind of stuff. But then the particulars of how to implement that or what to choose to lend to is outsourced to the SubDAOs. So the relationship, it's not exactly this, but I think the best analogy is a central bank, commercial bank lending structure.
Yeah.
So Maker, and I'll refer to it as Sky now because this is the rebranded version of Maker, but these are interchangeable. Sky is now more of a central bank where it does wholesale lending to the SubDAOs at a consistent wholesale rate to all of them. And then Spark is more on the commercial banking side. So we do lending to within our own lending market, which is called SparkLend. We do lending to other protocols like Aave, Morpho, and most recently we've onboarded Fluid as well. But the idea is that we will, and this works multi-chain as well. So the idea is that we are moving more to this broad allocation across all of DeFi. And the benefit here, there's many benefits. So if you are a user who is lending, we have a savings product where people can deposit USDC, soon USDT as well. And they will be able to go into what's called the savings rate, which is this cross-chain aggregated DeFi yield. And then on the borrowing side, because of this direct liquidity injection cross-chain, we're able to stabilize the rates on all the lending markets. So previously, if you're on you're using Aave on Arbitrum or something like that, and you borrow $10 million in USDC, that would spike the rates. And then you have to wait for more LPs to come in and provide capital. So Spark is the one that is the LP.
Interesting. So who would you say your customer is?
So we're more focused on a B2B to C structure now. So we're doing lending through other lending protocols. So, Aave is very big. It has a big user base. And so we can just tap into their user base by lending them USDC. So we're shifting more to B2B, but we also do have our own app spark.fi. And so we want that to be the baseline where users can it's just like a no-brainer way to get access to the savings rate on whichever chain they are. So we're now deployed on Ethereum base, and we'll be on Arbitrum probably even when this podcast is live. And so users can, if they have some USDC on base as of right now, it could be 10 million, it could be 50 million, it could be like these pretty large numbers, and you just deposit into the savings rate. We facilitate the liquidity as Spark between USDC and USDS, which is the Sky stablecoin. And then people can get this savings rate, which is currently 6.5%. So we're able to deliver an above risk-free rate return. And usually it's quite good in bull market conditions.
So basically a user would pick, Sparkland in this case. Sparkland is called, or just Spark?
Sparkland is the lending market.
It's the lending market. But a user would come in, a retail user would come in and use Spark as opposed to, let's say, Aave for better rates.
So you can use whatever you want. I think that's the broader point with the borrowing side. But I think most people, they just want access to, like, DeFi is confusing, it's complex, and they just kind of want to get access to the yields that are generated by all the people who are borrowing and levering up. So instead of having to think about this super hard and be like, oh, should I deploy it on Morpho, or should I deploy it on Aave, or should I deploy it on Sparkland, or whatever? There's so many options. We're just exporting the aggregated yield across through all of our operations, which covers basically everything, to the user, so that if they're on base, the thought process, it can be as simple as you have some USDC on base, you deposit into the savings product, and you just you get access to the best risk-adjusted yield in DeFi.
So do I understand it correctly? So, okay, in that example, I'm on Arbitrum, I deposit my USDC, but if at a given time, on chain, another one, like Base or whatever, there's better yield, I benefit from that.
Exactly.
So you're aggregating, basically, it's kind of the reverse. So is this an answer to for fragmented liquidity?
Yes, this actually is solving US dollar liquidity fragmentation within DeFi as a whole. Yeah.
And so that's very, very interesting, because where most ecosystems are focusing on building, let's say, the TVL and building an ecosystem inside, let's say, the chain, you guys are then building on top of that again.
Yeah. So we're abstracting away the multi-chain nature of DeFi such that users can just interact with their favorite apps.
And so, how do you see, let's say, the narrative developing on stablecoins that are going multi-chain?
Yeah. So we are the biggest stablecoin that's going multi-chain, and there's a unique advantage actually to on-chain stablecoins, and I want to maybe differentiate between what the different categories are, because stablecoin is a very broad term. So what I view it as, there's kind of two broad categories of stablecoins. There's the fiat-backed ones. This is USDC, USDT. So these are full reserve stablecoins. They need to be 100% backed by treasury bills mostly, but also cash.
Yeah.
And so we are one layer below that. So you can think of it like USDT and USDC are the M1 money supply of crypto on chain, and USDS is more of the M2 credit supply. Mm-hmm. So credit can serve a much broader audience because it does not have these strict requirements of full reserve. Now, to be clear, it's still over collateralized. This is important. The collateralization is what the important part is. But this is more this is how we're able to deliver this better than the treasury bill rate, precisely because we do this lending to over collateralized crypto vaults mostly. This is where the yield comes from, and this yield source has been put through the ringer for 6 years now, ever since Maker first started doing CDP loans with ETH over collateralized loans. This system has been completely robust. There's been very, very little, there's actually been no bad debt that's ever occurred from these, with ETH and Bitcoin as the collateral. So it's just a very, very relatively safe yield source, but still gives you access to the high returns that come from, people taking leverage in bull markets.
And so, is it safe to say that, how do you, what role do you see, let's say, all these other yield aggregating stablecoins in this play? Will Spark be a destination for them as well, where you would absorb that liquidity, or is it just going to be, because right now it's ETH, Bitcoin, USDT soon.
Mhm.
Is there going to be any other sources of stablecoins that could deposit or?
Yeah, I view Spark as continuing to onboard multiple stablecoins. So stablecoins are actually, so the yield-bearing stablecoins, that is basically just a yield-bearing interface to the dollar. So like that can represent anything.
Hmm.
So I think interesting example that's come online more recently is Athena, where they've tokenized the basis trade on centralized exchanges. So we as a on-chain stablecoin are able to tap into that yield that we previously couldn't access, precisely because somebody has tokenized this trade. And so then we onboard that as a collateral, and we're able to tap into that yield. But this is true for really any type of investment product. So yeah, I view the future as like we're really, within a certain scale, we're just going to support everything.
Are you looking at is Spark looking outside of lending, or is it just going to be mainly lending focused, lending and borrowing?
It's lending focused, but we are interested in getting more involved into DEXs. I mean, these are the two main things: it's lending and DEXs. Yeah, that's an area we're going to be expanding out to a lot more in 2025.
And so, Spark, next 5 years, what do you see like on the roadmap?
Yeah, I mean, 5 years, I think if we're talking about which blockchain you're on, we have failed. I think it's going to be for the, if we're going to onboard like the world into this stuff, it needs to your grandparents need to use it. And so it needs to be very simple. The current status quo of like setting up wallets and key management and all this kind of stuff. Like, I think actually a lot of this can, oddly enough, will go back more into like a centralized, manager for people, like more like the DeFi mullet thesis. I think it will look a lot like that, where it's like, you have these centralized but also very curated experiences for users who maybe don't want to maximally be DeFi degen, hold your keys and that kind of stuff. And so I think there's just going to be a wide variety of stuff. And so for Spark, we just want to be backing the infrastructure here to provide this really easy user experience. And so the savings product is the flagship product, where we're able to just abstract away all the complexity of DeFi and just distill it into this very simple product that people can use. And it's been proving itself over the years. We have over $8 billion about now in total deposits. So it's and it's been growing rapidly. I think over the past month we've had 30% growth. So it's it's been significant.
30% growth in the last month. That's insane.
Yeah, billions of dollars. It's quite a bit. So we just think it's a very compelling product, and with the multi-chain aspect, we think a lot of newer users are going to come onto things like Base, and so we want to make sure it's there, that they don't have to be paying the gas of Ethereum, but they can still benefit from the the collective TVL of Ethereum.
It's so interesting because a while ago I said I think aggregation won't happen through bridges or interop solutions. It's going to happen on an application layer, where through a single interface the user actually doesn't care or doesn't know which chain their assets are on.
Yeah.
And so in line of that, in that line of direction and thinking, are you going to focus on retails and keep simplifying the user interface, then also go mobile first? Is that a direction where you're going to either partner up with certain wallets or abstract that user experience away? Because you also already mentioned something like, in crypto, obviously, not your keys, not your coins, etc. And then is Spark thinking about a world where you provide, let's say, abstract away even a simpler user interface for normies?
So, well, as I mentioned, we do want to provide a baseline. Our focus for the more long term is to just have a simple integration point for other distributors. Okay. So B2B is what our focus is to scale. Yeah. We're not really interested in building, the best wallet ever. There's tons of teams already doing that. And so we just want to provide a yield-bearing product to them, and that's the focus for us. But going back a little bit to what you said about the bridge aggregation, so that stuff actually does help a lot, even with the application level aggregation. So I think this is going to be the first step, and us in particular are going to be the ones to deliver this very soon. Actually, like this is like within 3 months we should start to notice the effects.
Oh wow.
Like as we scale this up, like we're just kind of in a beta phase, but like we're really ramping it up now. So once that takes effect, yes, we're going to have this application layer solving of liquidity fragmentation within all the chains that we support. But and then on top of that, so like there still is a delay between the bridging, the token bridging. So as of now, like it's usually about Ethereum finality that is the limiter here. So settlement time for rebalancing across the lending markets across chains still takes about 20 minutes.
Oh wow.
Which is not a lot, but it's still something. So having solutions like the Optimism Superchain or like AgLayer, these types of things, if they get the settlement time down within the chain ecosystems, this is just further improves the liquidity and capital efficiency.
How do you view a product like Across? Because Across actually, bridging is very, very seamless, few seconds, left to right.
Yeah.
Are you still looking at solutions? Like I often wonder how a superchain or the superchain bridge or an AgLayer would even fit into that world, where the main purpose is for a user to seamlessly move between ecosystems at a rate that's fast, but also it's safe.
Yeah. So I view these as different products, and they're going to coexist together. So products like Across, they're more like at the liquidity, like a third-party liquidity network. And so these are very useful at the user level. What I'm talking about is more like backend, like bulk settlement. So we're talking tens of millions of dollars. It's too big to use these like third-party LPs as liquidity. It just becomes too costly. So we're at the scale where we're larger than this, so we have to do the settlement ourselves. And so we're using networks such as Circle CCTP because we're moving USDC around.
Yeah.
We will also soon have Skylink, which is the bridge for USDS. And we'll be using USDT 0 as well, which these are all the similar stablecoin level bulk transfer mechanisms that are made by the asset issuer. And just because of fees and stuff like that, we have to use these like primary mechanisms rather than a liquidity network. But as on the user side, super important to have like even faster, like users shouldn't have to wait any time, right?
Yeah.
They don't mind paying, a BIP or 5 bips for a fee, like if it means it can be a minute. But yeah, we're more constrained about these like fundamental settlement times at the backend level.
Don't you think those worlds will converge? And I'll maybe provide you some context. I think that I agree. I think that having a native or canonical bridge, or like a bridge that has like higher security assumptions, through validity proofs or pessimistic proofs or whatever like people are implementing, obviously you feel more secure moving 10 million around across a bridge like that, as opposed to maybe using intents and solvers. What happens when intents and solvers start using ZK proofs or validity proofs? Because when they start like incorporating, like when you have at the end of the day, a bridge basically like blockchains are deterministic. You need a third party in the middle that's basically a service, listens to both, somehow connects them. And if you have an off-chain network that settles between two chains, i.e. you send me 100 USDC, intents and solves moves fast, but at a lower amount, that's fine. Higher amount, you're basically not willing to take the risk. That's also the liquidity issue of like, solving like, filling the order. But what if you, like I know some of these parties, they're looking at ZK proofs. And once they start implementing ZK proofs, basically you have a very similar product.
Yeah, I see your point. I think there's a couple of things here. I mean, one, within like these like more Ethereum bound L2s, there can be this like tighter cohesion between the networks, but there's still like Solana, right? Like it's a completely isolated chain. And so I still think there's a use case here for these liquidity networks. And I think even in the case of like L2s and stuff, branding is often like more important. Like MetaMask is charging a huge fee over like, some other DEX aggregators, but because everybody uses MetaMask, they're able to charge this fee, right? So like the users are just accept it because they like the convenience of the swap feature. So I think there's a business here for liquidity networks as well, I think, just based on brand and also like, more isolated chains, stuff like that.
Good point. I think one of the last questions I have for you is, if you look at, let's say, Spark right now, are you, and you have all these yield bearing stablecoins, do you see a world where you're bypassing them and just going straight to like, because you mentioned Ethena, there's like a bunch of others, Agora, there's Mount Protocol. Like, do you see a way, as part of your roadmap, a world where you're just going directly to the source of this yield and then providing that directly to your user base, B2B, whether that's B2B or retail?
Yeah, I mean, so us as Spark, we're not so interested in this. Like, we're not trying to do everything ourselves.
Sure.
So it's much better to just tap into the other teams that are specialized in this, and just, they can take their fee and like do a good job with what they specialize in, and we're perfectly okay with that. And so, where we want to reach with Spark is where we're fairly agnostic about like there's of course all kinds of risk considerations. So it's definitely not simple, but within 2 products, 3 products that are like the same, we kind of want to just let them compete on their own merits. So like lending markets, for example, I think it mostly depends on the collateral that you're lending against, and less so against like what the particulars of the lending market are. At the margins, there is some differences, of course. But yeah, we kind of want to reach this place where it's like, is the collateral ETH? Is it, on chain? Then, it gets like this sort of risk rating, and then we would just allocate it to the same as any other. So we're fairly agnostic, where the algorithm is just, objectively reallocating across all these opportunities based on how well they're performing.
So what's the last question? What's the next big thing for Spark? Is it just onboarding chains as you go, or is it going to be a new product, or?
Yeah, so onboarding the chains is definitely our highest priority. So we have Base now, Arbitrum, it's like out like this week. So
nice.
Yeah, so that'll be soon. And then, yeah, we just want to basically, EVM chains are pretty easy, but like we kind of want to go everywhere. So just, yeah, really ramping up this process so that people just have easy access to the savings product first and foremost. That is our top priority. But we're looking at a number of things. One issue we have in DeFi is that we're kind of running out of capital to grow into. Like, the total size of like the number of stablecoins that are searching yield is like about $15 billion. And so us being 8 billion of that, like to grow, we kind of have to grow the pie of DeFi. So onboarding more people into DeFi is pretty important. So we now have, Bitcoin ETF, ETH ETF, I think US dollar ETF, stablecoin ETF is like the next logical thing, maybe after Sol or whatever. But yeah, I think this is a very compelling product that we can export to TradFi, people on fixed income, pension funds, this kind of stuff. The yields in TradFi are heavily gamed. It's really hard to compete there.
Yeah,
but we have this like it's a good yield, and it's coming from people who are willing to pay for speculating on the price of ETH and Bitcoin and stuff like that. That's real yield with real users, and so giving more people access to this, it will bring more people into DeFi and further just bring everybody on chain.
Well, 30% growth in the last month, and that's a heck of a number. So I think you guys are definitely like onto something. And it's very, very interesting to see it. Actually, for me in my head, it's like the reverse use case where you're unifying liquidity. Like once like the ecosystem are building up, you're unifying the liquidity again, like by building on top of these ecosystems. And it doesn't feel like extracting value. Actually, it feels like you're just optimizing for the end user.
Exactly. That's what we're trying to do.
Amazing. Well, Sam, thanks so much for being on the podcast. And yeah, looking forward to where Spark is going next.
Yeah, thanks for having me.
All right.